Dinshaw Irani joins us. Let's connect with him and talk about markets. How is the new mutual fund going? Have they allocated all the capital? Last time we invited him for lunch at our office, and I'm still awaiting an invite for coffee at his office, which continues. What can I say, Dinshaw? लंच खिलाया मगर कॉफी का इनवाइट नहीं आया. दिवाली हो गई, मिठाई नहीं आई.
Nikunj, you're always welcome to our office. Whenever you are in this part of town, you can always call up and you can always write up.
There has to be a formal invitation.
Yeah.
It looks like I'm self-inviting myself.
No. You are a very busy man, so that's what I'm doing.
Okay, what's been your market approach? I mean, let's first start with the fund. You've raised money, and have you started allocating the capital, or are you sitting on cash?
Nikunj, we are very different from the rest of the players, I guess, because when we got the money, as we were getting in the money, we were investing. In fact, we opened when we opened NAV on 15th, we were fully invested. There was 98% invested or so, and we're very clear. We're very clear on the markets. The biggest concern in the market was obviously the US Treasury yields, the 10-year bond yields, which were like shooting up. In fact, there was a term for that, which was called as bear steepening of the curve, and the 10-year yields difference between 2 and 10 shot up to almost around 120, 130 bips in June, but then narrowed down to almost 10 bips before we launch our fund. But that, fortunately, as gap has again opened up. In fact, the US 10-year yields have come down to 4.4% from 5 that they had hit. So that gave us a lot of comfort that one big competitor in the market for money was obviously becoming a bit more, a very unattractive player for Indian equities and such. So that is what drove us to increase our weightages. In fact, get fully invested as such. So that is where we are. Another big overhang has been obviously the local elections, 5 state elections which are going to happen. But I think that's already the market's building in a lot in that. And anyway, the biggest one is going to be the May one, which is the central elections. I think maybe that is why most of the market is going sideways today as such, maybe waiting for those kind of events to play out. But we are very clear, we are stock pickers, and that is what we like to do.
The fact that you've invested 90%, 98% for total corpus means that you see value in the market. The general argument is that there is no value in the market. Sliver of the market is looking okay in terms of value. So what has prompted you to invest 98%, and where have you invested?
So basically, Nikunj, as I said, that we are stock pickers. We always look for pockets within the market. In fact, whenever the markets are flatlining, that is the best time you can really, take your bets on. You have the time to evaluate your stock. You have enough time to gather your stock whenever you want, whichever one which you like. So that is what we like. And I think this was a perfect opportunity. The market corrected by the time we came up with our NFO and probably invested at the right time as such, I guess, keeping my fingers crossed here. But yeah, so that is how it is. Our probably 2/3 of our portfolio is in large caps, and 1/3 today is in mid and small caps. Our sector preferences are quite clear. Right? You also know this. We've been saying this all along that it's mainly financials and consumption. Again, consumption is mainly discretionary, and we have a very broad brush kind of a. When we say consumption, it's a very broad brush kind of a explanation, because we also include hotels and real estate and stuff like that in that. So those are the kind of plays we are working with as such. So that's where we are today.
Yeah, we all know your love for financials, but it seems like you've been avoiding FMCG. So when you say consumption, how are you making a distinction between the two? Are you only looking at the luxury and the affluent plays and not at, let's say, the rural plays?
So basically, rural has been quite it has not picked up for a very long time. Right? In fact, there were green shoots which totally vanished. Our feel is it's a structural play working out in the rural markets, because the non-farm labor is not picking up there. Now, that is where the real discretionary spends come in, when the non-farm labor picks up. Till then, it's all staples. because farm labor has been pretty okay within the rural markets. And non-farm is a play on the unorganized sector, which I don't think is going to pick up in a while from now as such, because of formalization of the economy. Yes. Yeah. So that's why we are very careful on our plays within FMCG as such. And as you rightly put it, it's mainly the premiumization that you're looking at here. And there also we have only one player, which is in the FMCG part. And that also is not actually FMCG. I mean, the most FMCG of FMCG is tobacco. So that's one of the players that we have here. But apart from that, we don't have any other FMCG play as such. So.
Dinshaw, hi, morning. What about defence, railways? Do you think the move up there has been too fast, too furious, or there is still room for more upside?
So basically, defense, I think, has a long-term going forward, it's a longer-term play that will work out in defense. And frankly, I mean, our feel is that we have to avoid the cyclicality within defense. And when I say cyclicality, I mainly mean the kind of capacity constraint that most of the players have. So you need to be in plays which are more of a, they're across various services in defense. Basically, electronics is what I'm talking about. And obviously, we're looking at also outsourcing plays within defense as such, because I believe that India will, at some point in time, be an outsourcing play for defense. And frankly, I mean, after all these problems that have come up with Ukraine, Russia, and Israel and Gaza, the world has started spending more on defense as such. In fact, the EU, which was earlier very dominant in terms of defense spends, in fact, Germany was the lowest which is spent on defense. They have also upped their budgets in defense. So I think they need to outsource to various countries, and I think India will be one of the fair beneficiaries of this. So you need to work out those plays as such. So it's a structural long-term play. And there again, as I said, that you've got to avoid the cyclicality within, and that's why you've got to be very selective in your stocks in defense.
Dinshaw, so what to your mind should be an ideal strategy in the run-up to the general election? Because it's December now, and May is when the event is. Do you think that markets which tend to rally ahead of the election cycle, they will rally this time also?
So, Nikunj, the fact is that the rally would have happened if there was some excitement going forward as such. I don't think that's happening actually. I mean, our belief is that it'll be more of a flat line. I mean, if you split the market, probably it'll be into two parts. One will be prior to elections and one will be post elections, because a lot of talk is being said during the. I think the state elections will be an eye opener. Basically, whatever the results come out, that will be interpreted to a larger extent, because this time around, the 5 states which are going to elections, they're totally a microcosm of what our general elections are going to be. 3 states, there are 2 central parties fighting each other. 1 state, there's a central and a local party fighting each other. And the 3rd state, there are 2 local parties fighting each other. So it's like a perfect play to understand what's going to happen in the central elections when they come about. So I think that will be looked forward to fairly closely. If things work out the way the market wants it to be, I think there'll be a rally in the works, some kind of a rally, small rally in the works. But the biggest question would be how the US Treasury yields work out. Though they've softened of late, but I don't think that's going to sustain there as such. So maybe that is what's going to play out. And frankly, I mean, today morning, another overhang. By the way, you said FIIs have been sellers all along, but if you look at the November figures thus far, and if you add the primary markets flow from FIIs, they're more or less even Stevens. I mean, they've sold in the cash market, but they've been buying in the IPO market as such. And today morning, when I opened the paper, I had to go through 5 pages of IPO ads. I mean, full page ads in my Pink Daily, which I like, and then the front page. So that's a big one which is sucking out the money from, I think, the markets as such. So that is what you've got to look out for.
Sure, you flipped through the newspaper and also saw lots of headlines on the Tata Tech IPO in particular. 791 crores is what they've raised ahead of the IPO. A lot of marquee anchor investors. Have you picked anything up or looked at any interesting companies? A lot of debuts this week?
No, I would like to comment on this since now we're running a mutual fund. But no, I don't think we're too excited in the IPO market as of now. So I would rather stay away from that.
What else are you avoiding completely? Where you say, okay, business is bad, valuations are higher, or valuations are higher, but even though business is good?
So basically, Nikunj, FMCG is one area which you need to avoid. I mean, I don't think sustenance of 60, 70 Ps for most of these stocks, 1 year forward Ps I'm talking about, is possible given that even the rural markets are not firing and the growth rates are in low teens or even high single digits as such. So that is one area that you need to avoid. The second one is outsourcing and mainly IT within that space. Because I think there's a lot of hope trade being played out here that probably there'll be a rate cut happening very soon in the US, and that's why discretionary spends will come back into the IT budgets as such. Not happening. I mean, I think December will be again the quarter will be another eye opener for all the hope trades which have happened, and probably you'll get to see a feeler. So our feel is that FY25, fiscal year 25, is not going to be as exciting as everybody is building in today. But maybe it'll be FY26 when you can look at that space. Then again, paints is one sector which you need to avoid. A lot of competition building in, and obviously the fact that the commodity prices have held them to an extent. But of late, the demand also hasn't been picking up much here. So obviously, the Ps there again are sustainable. So these are the kind of pockets that you need to avoid going forward.
There is a
Wherever basically you see the froth in valuations without any supportive growth in earnings, I think that's where you need to avoid.
A lot has changed for banks, Dinshaw. I mean, while credit growth is strong, but NIMs are coming under pressure. RBI is saying unsecured loans are too high, they could pose a systemic risk. Banks have been riding on unsecured loans and high spreads. That is leading to profitability. High interest rates have aided their NIMs. All that is history now. So do you think the outlook for banks actually could get dim and the underperformance will continue?
So Nikunj, on the risk weightages, which RBI came back and said that okay, you need to increase your risk weightages for various lendings. I think they went back to the pre-COVID levels as such. So I basically they came back to that level. The only thing was they came down heavily on the NBFCs rather than anything else. So that is a good part about RBI. I think they've done a wonderful job in controlling the asset quality within the system as such. So that is one thing that you should look out for. Talking about NIMs, the earnings growth can, to an extent, the NIMs can help to an extent, but actually the real re-rating of the sector happens once the credit growth picks up. And I think that is where the excitement is building in. In fact, last quarter also, mid-teens to high teens was the kind of credit growth that one saw in most of the banks as such. I think that is an exciting part, and it's mainly driven by consumer financing and stuff like that. So it's fairly good. So in fact, that is what our call has been, that if you're looking at an economy which is going to grow, and India is going to grow, the economy is going to be the fastest growing economy in the world, and of that size at least, you need the financial sector to kick in. You need the consumption to kick in. And I think that is what is working out perfectly for us today. And given the fact that we've got 65 odd crore young people, which are aggressive spenders, not ultimately spending though. But the fact is that is what is the exciting part. I think we'll be right at that point when probably China was in the early 2000s. And I think we are on a very good wicket today. So just taking a phrase out of cricket.
Okay, good to have you on board. Thanks so much for taking time out, Dinshaw. It's always a pleasure interacting with you and understanding your market outlook.
Pleasure.